All right, a very good afternoon, everyone. I trust everyone is well. Please kindly complete the attendance register for today. I will be posting the question that we'll be working on today. If you can just quickly on your side complete the question, the attendance register for me. And then we will start shortly, just to give you a few minutes to go through the register. I am trusting that everyone is doing well. Um, I see that a few people have currently joined. I'm hoping that most will be joining soon. So let's just give a few minutes whilst you are completing the attendance register. Um, and please indicate to me if you do not have the link so that I can provide the relevant link. All right, it looks like we can start. I will quickly share the link again for the attendance for those who were not able to see the attendance link. If you can just quickly capture your details for the attendance, please. I'm just sharing it for the second time, and I'll be sharing a question shortly. Just before I share a question, can I just quickly confirm if there's anyone who has got a burning question before we start today? Can anyone just quickly speak on your side just to be sure that you are able to hear me?
I can hear you.
Lovely. It's always a very important thing with technology that one has to quickly do the check-in to ensure that one is heard by the students. So let's quickly.
So can I ask you a question, sir?
Sorry?
Can I ask you a question?
Yes, you can.
So when can we like expect our assignment 2 results?
I will post your questions to the lecturer. I have not been given those results. However, I will ask them so that if when we have the next class on the 31st of August, I can more or less be able to give you the answer.
Okay, no problem.
All right. All right. I'm just writing the email. All right, sure. I've just done the question and send it through. So let's see if she will reply whilst we are doing the class, or if ever I will have to provide you an answer next week. Let's see. But thanks for the question. Let me quickly share the question that we are going to be doing today. I'm just going to upload it. It's a question that I'm hoping that it will help us in terms of unpacking the principles of deductions, allowances here and there. We will see how far the question helps us to remember the topics that we have covered previously. This is one of the old exam questions. I'm currently sharing it. It should, there it comes. It's a question one that we'll be doing. We'll be calculating a tax liability of a company. And then we'll also do another question. So it's very important for me that we unpack on deductions, but couple that with capital allowances. We'll also cover one of the deductions, which is donations as well. And then we will also do part C, which we will recover capital allowances again, and a bit of deductions. So I would love that you quickly on your side, you download the question, and then you start making notes on your side. This is the question. This is the question. It's question one. I'm currently just sharing it on my screen, but I'm hoping that on your side you are able to download it so that we can do it. So when you are doing this on your own at a later stage, it's very important that you do it under exam conditions. Also, to note that in an exam, there's always a hypothesis that is applied. So there is imaginary year of assessment that is applied. Um, and this is just meant to test your knowledge. It is always asked that you, even if it's future dates that are used here, that you apply your 2020 legislation, which is currently applicable in terms of your prescribed textbook and the study guide, as well as the tax rates that are applicable in any case. So you should be able to have access of these. So what is important in doing this question is we have to understand that we have to show all workings. When an amount is not applicable, for us to put it down, we provide the reasons why. And we must also round off amounts to the nearest rand. So let's see what we can do in terms of this question. So we are going to in terms of the required, we have to calculate a tax liability of Guitar Hero, a private company, for the year of assessment ended 31 March 2050. 31 March 2050. And you are told, you are given the background information, and then you are given the transactions that are applicable. So I'm just going to give you, say, roughly 6 minutes. So we're going to give you 6 minutes to read through the question, and then we will attempt the question together from 5:15. All right, we'll start just now. If you can just quickly, anyone who can indicate for me if they are done reading the question so that we can quickly go through the question together.
Yes, we are done.
Ah, lovely. All right, we'll just do the question just now. Let's just give one last person to just finish making their notes so that we can attempt it. All right, this is questions that normally would, given the length of the question, it's a bit of a marathon. It requires one to be calm as they are reading the question. So we will be making notes where possible. Where not possible, we will just be highlighting. So Guitar Hero, we can see here, if a company has got PTY Ltd, what does it mean? What type of a company are they?
That's a private company.
100%, that's a private company. So we already know one thing, that we are dealing with a private company, but we need now a confirmation of whether they are a micro business or a business corporation. When you are reading, so we are told that it is not a small business corporation as defined in the Income Tax Act. So this is to guide you that you don't use anything from a small business corporation rules that are applicable to SBC. The company manufactures all kinds of instruments. So it's very important that you note that we are dealing with a manufacturing company. So they manufacture all kinds of musical instruments, including guitars, pianos, drums, and it sells these instruments to one retailer in South Africa, namely Music Moods CC. Guitar Hero's financial year ends on 31 March. The accountant requested that you calculate the company's income tax liability for the year of assessment ended 31 March 2050. So one of the things that we know about a manufacturing company is we must know how to apply Section 12C for manufacturing assets. And we must also know how to apply non-manufacturing assets. We must also know how to treat movable assets if we will be given in terms of Section 11E. So these are important sections that we must note so that what is going to happen. This is in the event that we have to do a calculation for capital allowances, but we do not know this up until we read the information. So sales to Moods LCC amounted to 6,865,000. So we know that this will be our income. So this is gross income. It is revenue in nature. A donation of 150,000 was made to Lifeline, a registered public benefit organization. The relevant Section 18A receipt was obtained. What must you do about this donation? When are you going to use it? Anyone?
I think it's going to be at the end of the statement.
So we will need this at the end of calculation before tax liability. Okay? So it's very important that you note when you're going to need things. The company purchased raw materials amounting to 3 million and paid transport company 8,600. So this will be your cost of sales application, exactly like you apply your cost of sales. So you will claim a deduction on purchases. We'll speak about transport. Guitar Hero created a new computer program that would simplify the manufacture process. Research and development expenses incurred in developing the computer program amounted to 375,000 and were incurred on 1 May 2049. Salaries paid to research staff amounted to 98,000 and were also incurred on the same date. Approval was obtained from the minister as well as Department of Science and Technology for the development of the computer program on 15 April 2049. So we will look here in terms of section 11 1D. We'll look in terms of section 11 1D, how it applies. Bad debts written off during the year. The following table relates to list of doubtful debts. We'll see how we'll apply the information together with reading the years that are given. The following information relates to fixed assets. So we've got 4 bulletins. Guitar paid 110 to the local municipality for water and electricity. The following employee expenses were paid. We can see them. We'll talk about them. There was a robbery with and some 5 guitars were stolen. So we'll also touch on this. Binding general rule. Very important that we remember this paragraph as we answer questions. It's very important that we remember the binding general rule. We see that they've elected to use the section 11.0 scrapping allowance. It means that there is a disposal of an asset or a deemed disposal. Can anyone tell me what is a deemed disposal? Anyone? Is everyone no longer there? Ombagazi, do you want to answer what is a deemed disposal? Anyone? All right. I'm hoping that we will be as interactive as possible when we are answering the questions just now. A deemed disposal, it's a process that does not have a voluntary buyer and a seller. It's in the case when your assets are stolen, when you have donated them to close ones. So because you have not sold them, from a tax perspective, it would be regarded as a deemed disposal. So let's quickly try now to make up a answer sheet for question 1. Let me browse here. Right, let's quickly take the question. Here is our question. We're just going to populate this to be here. I'm just dealing with a little bit of some admin in order to allow you to see everything that I'm trying to do. Right, we'll have some amounts here. some amounts here. Right, so we first have an income part. So under income, so how a tax question will be given to you has a bit of some logic in terms of what starts and all that to allow you an opportunity to be able to answer the question without much hassle. So number one says sales to music, Nude CC. That would be our income. So this would be sales. Maybe let me not put this. So we've got sales of 6,865,000. Right, number two, we've got a donation. We said this is going to be included in the end, so we must remember as we move on. So the company purchased raw materials amounting to 3,650,500. So the purchases would qualify in terms of deductions, in terms of your section 11A. So it becomes 3,650,500. What about transport? What about the transport costs? Does the transport costs that was paid qualify in terms of deductions? Anyone?
I think it must be deducted because it must be part of raw materials, because we're going to use the transport to transport the raw materials to the new yeah, I think I'm confusing myself here, but I think we have to deduct it.
Reasons? What are the reasons for deducting?
Because the transport, like like with cost of sales, I think I use it in the, because I think in order to get the cost of sales, we need to add the raw materials with the transport.
All right. So the main reason is in terms of the valuation of trading stock. Trading stock is you add all costs that contribute to bringing an asset into its location and condition as intended by management. So that's the main reason why this 8,600 gets deducted as part of the trading stock. So let's quickly look at number 4. So number 4, in terms of section 11D, so we're covering research and development, which is section 11D. This is just to help you understand what we are covering at a certain stage. So we have got a computer program. So does this computer program meet the requirements of section 11D? Anyone?
Yes, because it was approved by Minister and Department of Technology.
date of approval. What must you always check in terms of the date of approval? There is something that is very important for you that you must always check for. And what is that?
Date.
And what must you check on the date?
The date of approval, which is 15 April 2049.
Yes, I see, but what must you check in terms of the date?
I think it's because of it was approved before 1st May 2049 when the computer was developed.
100%. So that's what you always check for. It's the question of checking whether the approval was granted before the expenditure was incurred. And in this case, one can be able to see that it was given before the expenditure was incurred. Now, I just want us now to check something very important. How much of a deduction do we allow for computer program? Do we deduct the 375? Is that how much we must deduct?
Don't you calculate it by 150%? That's it.
All right, so this is what you say, because this particular expenditure qualifies in terms of section 11D, you therefore have to apply an allowance of 150% on the expenditure. What happens to the salaries to research staff?
Sir?
Yes.
Actually, I forgot to ask you this in the. I always wanted to understand when you say 150%. Like I don't really understand why it has to be 150.
This is a incentive that is given by the commissioner from an income tax act perspective to encourage companies to do research. Now, if most companies do research, scientific research, but before doing the research, they actually get an approval from the minister and the Department of Science and Technology. SARS says they are willing to give them an allowance which is above the expenditure that is incurred. So, which means that from your income perspective, you get to deduct more than you actually spend. So it's a rule in order to encourage companies to do scientific research.
So it means they give us incentive for 50% for doing research.
100%.
Okay.
100%. That is just exactly like you've just added now. So that's why we are using 50%. So now what I'm asking now is, what happens now to the employee portion that was paid to the research staff? What happens to the salaries paid? Do you just give a normal deduction? In this case of 98,000? Anyone who
Hello.
wants to try? Yes.
I think since it is a research and development expense, it must be it must have a 150% claim allowance.
All right. So the here in this question, it was just mainly to trick students to separate these two things as if they are independent. So the expenditure that gets allowed in terms of Section 11D, it's all expenditure incurred in the research program. So in this case, it will be both the salaries paid as well as the computer program that was created. And that will lead to us making a 150% percentage allowance on a deduction. So we are saying 98,000 is allowed, but we are saying in addition to 98,000 that is allowed, an additional amount is given as well as an allowance, which means you say 98,000 multiplied by 150%. Next one is bad debts.
Hi, sir. Before you continue, just want to understand when we do the liability, we have to put them separate and calculate them with the 150% separate.
Yes, remember you were given two amounts. So what is important in tax in order to earn marks and easy marks, whenever you are given separate amounts, it means the marking allocation is based on you attempting to separate incidences. So in this case, you are expected to tackle the computer program cost and to tackle the salaries paid separately, not add them together. Otherwise, your understanding will not be picked up as to whether you've got full understanding. Hence, in the question, it says, show all your workings. Happy? All right. Number 5, bad debts written off amounted to 58,960. What do we do with the amount?
Do we not multiply it by 20%? By 40%, I mean.
I like the guessing game. I just like the guessing game. Sorry, can you just give me a minute? I just need to quickly share the question to those people that just arrived a minute later after I had shared it. So I'm just sharing it again for those that just joined now. You can download the question. Paul has shared question 1. You can just quickly download the question. Ronald, I will investigate and come back to you on why the recording is not there of last week. Anyone? I've heard someone says you multiply by 20%, changing their minds again, and they say 40%. What is everyone thinking? Student in last week's class indicated that you are writing on 1st October. I'm hoping that it is still so. Then that would mean that you've got 5 weeks to prepare for your exams. Anyone speak to me? What do you do on bad debts? People always say when they want to move on and they say, in the interest of time, let us move on. I don't know if I want to say that, but nevertheless, if there is no one who's coming up with an answer, we'll have to quickly, I will have to quickly supply the answer. Bad debts less VAT amount, still not correct. So bad debts written off, the whole amount gets deducted. 58,960 gets deducted. Remember, this amount used to be in the sales before, in the previous years. But when you are writing off debts, you're actually saying, I did not get the amount that I was supposed to have got, that I previously recognized as income. This therefore means that in the past years, you paid more tax on amount that accrued to you, but that you actually never received. So that is why SARS gives you this incentive of being able to deduct bad debts written off. But remember, in a real company, you would have to show SARS proof that really that your bad debts were written off and the reasons thereof. But we're not going to dwell on that because we are not testing that today. So we deduct the whole amount. And then we've got list of
Sorry,
doubtful.
sir.
Yes.
For bad debts, don't we take into account the opening balance and the closing balance of bad debts?
Not for bad debts. Whatever you've written off in the current year as an amount that is not redeemable, that you cannot have from your customers, that amount you immediately say it is written off. You immediately write off the amount. So it does not work like that.
Okay.
Yes. So you deduct the exact amount that is not written off. Sorry, the exact amount that is written off. I'm sorry for that. I don't want to confuse. But whatever is written off in the current year, you deduct full amount 100% as 58,960. Now we are provided the next table. And this is important because sometimes all this information can be given on the same table. So it is important for you to note bad debts, whether you are told that they were written off or not. But whenever a company has bad debt, it means that they have done a write-off. So you have to take the full amount into consideration. Now, in this question, we are told the following table relates to the list of doubtful debts. All these debts are older than 60 days, but less than 120 days old. What must we do in this case on number 6?
We need to multiply them by 25% to get the allowance.
Why 25%? So we need to calculate what's called doubtful.
We need to calculate
Doubtful debt allowance.
debt with 25%. Yes, with 25% because it's less than 120 days.
So we multiply by 49 for 25% because it's less than 120 days old. So this means that we're going to take the list of debtors in 2049 and say 122 times by 25% and 97,000 multiplied by 25% for year 2050. Right, I'm getting two amounts here. Let's see what I get here. Multiplied by 25%, 97,000 multiplied by 25%. So the two amounts I have got, so I've got the two amounts. What must I do now that I have the two amounts? Do they both qualify to be a deduction? Do the two amounts qualify to be a deduction?
Yes.
I'm not sure if that is
Can you
Musumzi.
please inform all the students to switch off their mic? We can hear the background and it's
All right. Thank you. Everyone, if you can just unmute your mic when you are speaking, and once you speak, just mute it again, because other students are affected by the background noise. So that is noted. Thanks for raising that, Vusumzi. Quickly, anyone with an answer? Do these amounts both qualify?
No, there's some student who can hear a kid talking on the background and it's setting up, you know.
Yes, I've already addressed that, but now I'm asking the question, and the question that I'm asking is, do these amounts both qualify as a deduction?
I'm not 100% sure, but I think the 28,000 for previous year needs to be added back, and then we need to deduct the one for the current year, 24,000. I'm not sure if I'm mistaken about that.
Right, you are not mistaken. This is what is required in terms of the application of the law, that the previous year amount is always added back, because it's an incentive that was provided last year. When you said to SARS that you've got some doubts on amounts that you think may not be recoverable, and SARS gave you a relief, but SARS says once you do it again in the second year, SARS cannot provide you a same relief in the current year. Sorry, they can give you in the current year, but you need to add back what you already had from last year. So it's fine, Chantel, you are forgiven. So let us move on and see what is the next question. So the next question relates to fixed assets. So let's quickly read the first one that we are going to be dealing with. Now it's important that we remember the year of assessment is 2050, starts on 1 April 2049. So on 1 August 2048, the previous year of assessment, the company purchased a range of new furniture for 36,000 for the distribution office. On 1 October 2049, the company relocated to a new distribution office, and the furniture was moved on the same date. The moving cost amounted to 15,000. So we've got furniture. So we must calculate the allowance. So how would we need to calculate the allowance for furniture for 2050 year? How would we calculate the
I
furniture?
think we're gonna apply 30%. I think we're gonna apply 30% for the because it's 50-20 50-30-20 rule. So we're gonna 30%.
Why? Where do you take that rule? Remember, this is not a small business corporation.
Oh yeah, I use the small business. Small
Remember,
business
you've been told that this is not a small business corporation as defined. So this means that we have to use section 11E. And in order to use section 11E, it means that we have to know the binding general rule for the right of periods of furniture. And here we are told that furniture and fittings is period of 6 years. So here we are dealing with furniture. So it means that the allowance calculation, capital allowance calculation, will say how much was the furniture? 36,000 divided by 6 years. This is how you would calculate the allowance on the furniture as 36,000 divided by 6 years, and that gives you a 6,000. And then you've got a second thing, which is the moving cost of relocating a company to a new distribution office. What do you do with the moving costs?
Claimable over the lifespan of the asset. So we are going to take the moving cost divided by the number of years remaining for the asset.
All right, so you are told here specifically that the asset was moved on 1 October. Remember, one of the nice things about Section 11E, where binding general rule applies, is you can apportion the allowance to the period that applies. So in this case, how would we apportion it?
I would say 15,000 divided by 5 years.
15,000 divided by 5 years. What is another person saying? What is another person saying?
I think we divide by 6 months. If you are to calculate from, like, if we say 15,000 divided by 6 years times 6 months for the time that it has been moved, from the time it was moved up to the year end of assessment.
So we say 15,000. Is it 6 months?
Yes, 6 months times 6 months. If actually the year of assessment is March.
Correct. Do we calculate it the same way that we calculate depreciation?
I think so. I'm not so sure, but that's what I think.
I think you do, yes.
So when we apportion it, we are going to say 15,000 Remember, a moving cost is not an additional cost. Do we all remember that? Let me just quickly find a way if I can quickly get a textbook online just to open the specific topic that we are on. Because you cannot say 15,000 as if that is a purchase price of a cost. So it's a moving cost. I quickly want to get a textbook and hear what it says about where we are.
It says if it's a moving cost, it can be apportioned installment over the years that are still to be written off on an asset. But if the asset is already written off, it should be deducted in full in the year it incurred. So I was thinking we have to take the moving cost according to the 6 years the property, the furniture is going to be depreciated. But because we already have 1 year that we have taken off plus the 6 months, so I think it's going to be that 4 years and 6 months.
Remember, sorry, I'm glad that was quicker. Remember, in the previous year, this was bought in the middle of the year on the 1st of August. It was not bought on the 1st of April. So we have to write off the moving costs on the remaining years of the depreciation of this asset. And the question that I'm asking is, what would be the remaining period? How do you calculate the remaining period?
The remaining period, isn't it 5 years, 6 months?
I would say it will be for 58 months because of the 72 months, which is 6 years, we've already used 14 months because for 1st of August to 31st March was about 8 months, and then the 6 months when we brought into use when we moved it, so that adds to 14 months. Then from the 72 months, we will be left with 58 months.
Does everyone understand that? So you are saying, just for everyone to make sure that they understand the timeline, this asset was purchased on 1 August 2048. So this is when the moving cost, the write-off starts of 6 years. The moving cost only happened on 1 October 2048 and 2049, sorry. And we need to calculate as at 31st March 2050. What is the allowance that should be allowed in terms of the moving costs? So just quickly summarize that again for everyone to understand how you got to 48 months.
I took the years, it's 72 months, which is the 6 years. So from
it's 6
1st
years,
of August.
so it's 6 years multiplied by 12 months. That gives you 72 months. Yes, go on.
And then from the 1st of August to 31st of March, it is 8 months. And from the 1st of April to 1st of October, it will be 6 months. Then when you add the 8 and the 6, I got 14 months. And then from the 72 months, I deducted the 14 months, then I was left with 58 months.
So this means as at the 1st of October, our write-off period that we can apply on moving cost, it is no longer 6 years, but you use the remaining period. So the remaining period, we can only now work according to months due to the years that will have commas and decimals, which might not work best for us. So in this case, it becomes 15,000 divided by 15 months. But remember, this is going to give you an amount per month. So you're going to get around let's say 258,62, which you must now still apply by 6 months of the remaining period in order to get the amount that should be there. And this amount will therefore be 1,552 rands. Does everyone understand?
Say, I'm still lost on how you come up with 58 months.
All right. So given that we have information that does not link to a full financial year, which is the cost when the asset was purchased and the cost when the asset was relocated. It's not a full year. It was done in portion. So we are saying here 1st August 2048. Remember, this is the 2049 year of assessment. We are saying here the period in which you have used this asset in this year. It's August, September, October, November, December, January, February, March. It's 8 months. Do you follow?
Yes.
Now in 2050, we look up until 1 October 2049 when the relocation happened. How many months had you used the asset?
6 months.
6 months. So in total, this gives you 14 months, right?
Yes.
Right. We say originally, the binding general rule gave us a period of write-off of 7 years. Correct?
Not 6 years.
6 years. 6 years, you are correct. 6 years. And we say, because now we are dealing in months, we're going to say 6 years multiplied by 12 months. And that is going to give us how many months?
72 months.
72 months. And we say this asset has already been used or written off for how many months?
14.
14 months. And therefore we say 72 minus 14 months, 58 months is the remaining period that now we can apply in terms of writing off this asset. This is the remaining period. Your moving cost can only be applied on the remaining period. Hence, we say 15,000 divided by 58 months gives you 258 rand 62 cents per month. But you multiply that by 6 months, and then it gives you this amount rounded off to the nearest rand.
Okay, thank you, sir.
Lovely. So it's important that everyone understands the principles and what the textbook says. Right, let's read the next one.
Sir,
yes.
During the exam, if I use years instead of months, will I not be penalized because, hey, this month thing is a long process?
I let me say I do not know. Let's see how would you have done that.
Okay, what I've done is 15 is I take 58 months, ne? It amounts to 4.83 years. What I did is 15,000 divided by 4.83. Then I got 3,105, and I take that 3,105 multiplied by 6 divided by 12, which gives me 1,552, which is the amount that you got there.
Oh, no, it's fine. It's fine if it works out for you. Because remember, you will show your calculations. But what is important is for you to remember that there is nothing called 2.43 years. That's where the problem is. Hence, when it's not a full year, we revert back to using the number of months, especially in such cases where you need to understand the flow. So find what works for you and make sure that you practice more questions around such nature, and possibly you can be able then to come to the same solution that you have. Then if this is what works for you, then you apply it in the exams as well.
Okay, thank you.
Lovely. So the second one, the old furniture was only sold on 1 August 2049 to a second-hand dealer for 18,000. This old furniture was originally purchased for 25,000. So now this means that, and it was purchased on 1 July 2048, which is the previous year of assessment. Now this means that we need to calculate a section 11O allowance, because now we have disposed, we have sold, we have disposed an old furniture. Now, in order to do that, we have to learn now a few things. So we have to calculate a scrapping allowance. To do that, we have to know a tax value. Now, to know a tax value, this therefore means that we need to say cost less capital allowances. So our cost is therefore 25,000. How much would our allowances be? So we need one for 2049, and we're going to need one for 2050, which is the current year. So quickly give me, well, how much are you getting? So it's 25,000 divided by 6. Because this was not purchased in a full year from 1 April. So we're going to say 1 July to March 2049, and that gives you 9 months divided by 12. So this therefore is 25,000 divided by 6 multiply by 9 divided by 12 gives you 3,125. And for this year, it was disposed in it was sold in 1 August 2049. So we have to calculate from 1 April to 1 August. So let's see, 25,000 divided by 6 multiply by how many months now? It's going to be April to August, April, May, June, July, and then that is 4 months, because it was sold on the 1st of August. So here we're therefore going to have 25,000 divided by 6 multiplied by 4 divided by 12. And then we have 1,389. This 1,389 remains an allowance for the current year that must be added. Hence, I have 2 columns here, because this must still be added as a capital allowance in the current year. So from here, we get what we call a tax value. And our tax value is going to be 20,486. And then we're going to say proceeds. And how much was it sold for? 18,000. And from there, we're going to get a scrapping allowance. So if our proceeds are less than the tax value, we get a scrapping allowance. If it's more than that, then we get what we call a recoupment. So in this case, it's going to be 24,886, which is therefore going to be a deduction because it's a loss that we have made. Hence, we call it a scrapping allowance minus 2,486. Then we've got two manufacturing machines that were purchased on 1 July 2048. Manufacturing machine A bought for 220,000. Manufacturing machine B was bought second-hand for 125,000. So let's quickly deal with manufacturing machine 1. How are we going to calculate the capital allowances? Anyone? How do you calculate manufacturing A? Manufacturing A, it's going to be 220,000, and you're going to apply section 12C. And what does section 12C say in terms of the allowance that you can provide? If you brought on the machine in the current year, a new machine, what does 12C say?
You get a 50% allowance.
12C. Please check it again.
40% allowance.
It's over 40 years, so it's 40% allowance. So it's 220,000 multiplied by 40%. Machine B, a second hand. How do we write it off? It's written off over 5 years because it's a second hand, so it becomes 125,000 multiplied by 20%. Please note the dates again. This is not apportioned. You only apportion section 11 A, section 11E. Now on 1 March 2049, sorry, 1 May 2049, which is the current year of assessment, the company purchased 5 new apartments in a residential building in Cape Town at a cost of 650,000 each. The company rented these apartments out at 3,500 each from 1 May 2049 solely for the trade purposes. So we have to look at an allowance for residential units. So it's residential units.
It says 5% allowance.
So we apply there what we call section 13 sex. So someone says the purchase price. So what did you say we apply? 5%. And when they are new, what do we apply? So I agree. We apply 5%, but there's another percentage that we apply when they are new. And what would that be? We have to apply first 55% allowance because they are new. So remember, it's how many? It's 5 new apartments, so it's 650 multiplied by 5 apartments. Then you multiply by 55% because they are new, and then you multiply by 5%, which is your annual allowance. So it's 650,000 multiplied by 5. Let's put that in brackets. And then we say multiply by 55%, multiply by 5%, gives you 89,375. So the key thing for you to note is when they are new in the current year of assessment, you've got an additional 55% that you can apply. What do you do about the rent? What do you do about rent? Remember, this is an income that we have earned, so we have to put it in the tax liability calculation. So what must we say in this case? How do you calculate it? Anyone? How do you calculate the rent?
Sorry, just a question, but would you not deduct the rent from that amount?
Because I thought we need to deduct it since it's out of the assessment period.
Yes.
What is out of the assessment period?
That amount, don't they said it start being paid in May, yet our year of assessment is ended in April. So that month of May is out of our.
Let me remind you what is the year of assessment. The year of assessment is 1 April 2049 to 31 March 2050. In case you've forgotten, this is our year of assessment.
So would you then not take that 3,500 and multiply it by 11 months and deduct it from the original allowance deducted?
Why are we deducting it? It's an income. Why must we deduct an income?
Because you're already receiving the benefit of having a new building.
Nope. Nope. SARS is giving
Do we
you an
have to
allowance.
check if the rent is 1% or not?
Not necessarily in this question, but you can also do that check as well. And if you do your check, what do you get? All right, maybe let's do this. Can anyone who has got this particular prescript on the textbook quickly read us what does it say about apartments that is on section 13(6)? Anyone? Just the application of the allowance so that you understand it, that an annual allowance is 5%. If we're dealing with a new purchase, then it's going to be 5%. So let me quickly go here. So this will not cover everything. But if you can just quickly check for me, section 564 in the textbook.
So it says low-cost residential unit. Where the unit qualifies as a low-cost residential unit, the taxpayer may claim an annual allowance of 10% over 10 years instead of 5% over 20 years. Section 1 of the Income Tax Act defines a low-cost residential unit as either building qualifying as a residential unit located in the Republic where the cost does not exceed 300,000, or an apartment which is a residential unit in a building located in the Republic where the cost does not exceed 350,000. Where the building or apartment is let, the owner must not charge a rental that exceeds monthly 1% of the cost. The building plus a proportionate share of the cost of the land and the bulk infrastructure, the apartment. The cost of which 1% per month is based can be increased by 10% per year. The first increase in the tax year following the year in which the building and apartment is first brought into use.
All right, I hear that part. I just want to go back again to the pricing of a residential unit if it's not a low cost, because what you read may be section 13 sept, but I am just looking for section 13.
It's fine. Let me read you from the top then. Section 13.6 is allowable, is an allowance available to taxpayers who buy and let residential property. Where the taxpayer acquires a residential unit after 21 October 2008, a 5% residential allowance may be claimed by the taxpayer provided the requirements of the section are met. The residential unit must be a new and unused. If the allowance is to be claimed only on an improvement, the only improvement needs to be new and unused. The taxpayer must own the unit, therefore the allowance cannot be claimed on improvements made to the property that the taxpayer occupies as a tenant or uses as a lessee. The unit or improvement must be used by the taxpayer solely for the purpose of a trade which he carries on, and the unit must be situated in the Republic of South Africa. The taxpayer must own at least 5 residential units in the Republic. They need not be at the same place, which must be used for the purposes of trade carried on by the taxpayer. And it seems that the other units not be subject to the Section 13 Quin allowance in order for this section to apply to a new unit. As the unit has to be used solely for the purpose of the taxpayer trade and used mainly for a residential unit, it can be either let as a residence to an individual or used as accommodation for the taxpayer employees. No allowance is claimable under the Section 13.6 if an allowance on the unit or a deduction of the cost of the unit may be claimed under another section of the Income Tax Act.
All right, okay, thank you. I think more or less what I am looking for is the more in terms of the costing of a residential unit, and I'm just quickly checking. But when it's new, you can apply 55% in the current year, and then you can apply again 5% of the allowance, which as I've indicated in the calculation. But in this particular case, of 300 and 350,000, it's when it's a low-cost residential unit. In this question, the only thing that we have been told is that it is a residential unit. So, which means that in terms of the residential unit definition, it means a building or self-contained apartment which can be mainly used for residential accommodation and excludes a building or apartment used by a person in carrying on a trade as a hotel keeper. So in this case, we are looking at a apartment as a residential unit, not necessarily as a low cost residential unit where you will need to apply the requirements that apply to it. So I'm just reading quickly an interpretation note. And I just want to go now to the calculation of an allowance. So the second thing, in order to be able to get an allowance, the residential units must be available to be let, because you have to be carrying on a trade. In terms of allowances, for you to get an allowance, you have to be carrying on a trade. So in this case, the rental indicates to us that this particular residential units were available for hire, which would in this case, in our case, would therefore mean that they qualify for an allowance for deduction purposes. So I just want to get the calculations. Because they are using these residential units for the purposes of trade. So I just want to get the calculation. I'm almost there. All right, the allowance is calculated at a rate of 5% a year on the cost of a residential unit. Then it's an additional 5% if it qualifies to be a low-cost residential unit. So in this case, it is only 5%. So let's look when it is new and brought into use for that particular year. I'm looking for where we'll get 55%. Yeah, there we go. If a taxpayer acquires a residential unit representing only a part of building without erecting or constructing that unit or improvement, the cost of acquiring that part or improvement for the purposes of Section 13(6) is deemed to be 55% of the acquisition price for a unit being acquired, and 30% of the acquisition price for the improvement being acquired. I think maybe it's important that I try to quickly show this online, because these things are very important. This is the interpretation note that I referred to. So I just want to show you quickly where we were reading. So the first thing here was we applied the definition of a residential unit. So I don't want you to go to low cost housing. This is what we did firstly. And then we went on. Just want to show you all areas that I read. And then we wanted to know the allowance that is applied. So the allowance is calculated as 5% on a year on the cost of a residential unit, or in the improvement, additional 5% if the residential unit qualifies as low cost housing. And in the case of part acquisition, it's 55% on the unit acquired in the same year. If a residential unit was acquired means bought without erecting or constructing that unit. If it's an improvement, then it's 30% of the acquisition value. So does everyone understand why we are saying 55% and 5%?
That section makes sense to me, but the rent is still an issue for me to grasp.
All right, let's quickly look the rent part, because it's also covered here. Right. I'll show you where it is covered. So where it is covered is, I do not want to cover it under low cost housing. How do you know that you must actually provide a deduction in this particular building? So one of the important thing in terms of the residential building is, I'm just going to it now, is that it must be used by a it must be used for trade. In order for you to give an allowance, is that it must be used for trade. So how do you know that it was used for trade as a residential unit? We know this because we are told that we rented it out. Because remember why you provide a deduction? It's because it was used in a trade. So what trade was it? It was in a rental trade. So in this case, it was a rental income that was earned. So because we earned money, we are required to reflect this money as an income in our books. So which therefore means we have to show rental income in our books as per the question. And the rental income will be 3,500 per month from 1 May 2049. So in this case, how much rent is this in terms of the calculation? Just calculate for me and just tell me your total amount. Your total that you are
I
getting for
am
rent?
getting 38,500.
1,500.
Right. This is where it happens that you may forget. You may forget where we were. We have got 5 apartments. So it's 3,500 per month multiplied by how many months do we have to year end?
11.
11. And guess how many apartments we have?
5. It's 192,500.
So that should be the correct amount. So it's 3,500 multiplied by 11 months multiplied by 5 apartments. That's 192,500. That's an income in our books. Hence, I call it rental income. All right, let's move on. Number 8, Guitar Hero paid an amount of 110,000 to the local municipality for water and electricity for the period 1 January to 31 March 2050. So what is our year end? It's to 31 March 2050. So in this question, what we are tested to apply is to apply what we call prepaid expenses. This is how prepaid expenses is tested. You are not told that someone paid prepaid expenses. So in this case, we have to separate what is normal expenditure and what is prepaid. So in this case, we are going to say expenditure for the current year is going to be 9 months, 1 March to March, that's 3 months. So it's going to be 110,000 multiplied by 3 divided by 12. This is going to be the expenditure in the current year. This therefore means that we've got a prepaid expenditure of how much? we'll have a prepaid expenditure of 110,000 minus 27,500, which gives you 82,500. Sorry, I just need to fix my signs. So we've got a prepaid expenditure of 82,500. And this is from April, 1 April to 31 December 2050. Now give me the two rules that are applicable to calculating prepaid expenditure. What are the two rules? For prepaid expenditure, anyone?
Prepaid expenditure are deductible if they are less than 6 months.
If it's less than 6 months, or
aggregate
the
of
amount.
100,000.
aggregate is less than
100,000.
100,000. So we know that 6 months is therefore not applicable. So we need now to read number 9, number 10, and number 11, just to make sure that there is no other prepaid expenses. Number 9, I see employee expenses. Number 10, it's a robbery. And it's an amount that was paid by the insurance. I'm not picking up any further prepaid expenses. This therefore means what? What does this therefore means?
It means that the prepaid portion of the expense is deductible.
All of it, 82,500, is therefore deductible because it is less than 100,000.
It's less than 100,000.
So you say prepaid expenditure, 82,500, is therefore deductible. Right, let's move on. Number 9, the following employee expenses were paid. So we've got employee expenses. So we have salaries and wages. How much is salaries and wages? Is it fully deductible? Salaries and wages? It's a yes or no.
Yes.
Yes.
All right, that's a yes. Then we've got contribution to medical aid.
It's also deductible.
Contribution to medical aid in respect of all employees. So this is the employer contributions. It's also deductible. And leave pay provision.
It is also deductible.
Leave provision. Remember, this does not meet the definition of expenditure. It's not paid. It's not leave payout. It's leave pay provision. Remember, this would be a prohibited expenditure. So it's not deductible. Why? Because it's prohibited. Provisions are prohibited deductions, therefore not deductible.
Sorry, can I just ask, how come leave pay provision is not a prepaid expense? Because provision, it's something you are providing for at the moment, but it's an eventual cost. You have to pay leave out eventually. So how come it does not form part of prepaid expenditure?
Let's apply general deduction formula. Remember, it is expenditure in CAD because you are doing trade. It must be expenditure or losses actually in CAD. Is it actually
Makes
in
sense,
CAD?
yes.
Ah,
Okay, makes sense. Thank you.
lovely. Sure. So we've covered leave pay provision. So number 10 says on 1 February 2050, just 1 month before the year end, there was a robbery. 2 months before year end, there was a robbery at the distribution office. 5 guitars. So it's always important that you read this correctly. 5 guitars with a cost price of 5,500 each were stolen. These items were not deducted yet as part of trading stock or production costs. In an attempt to recover the stolen items, the company paid a bribe of 1,500 to a security officer to try and find the culprits. The insurance company paid an amount of 20,000 to the company for the theft of the guitars because they were insured. So now we have to cover different areas in this question. So the first one that we can deal with is, so we say stolen guitars. Let's quickly deal with the bribe. Is the bribe deductible?
No.
Why?
No.
No, it's an illegal expense.
Right, it's one of the prohibited expenditure or expenses. Let me try to shorten it. It's prohibited expenses. Therefore, bribe paid is not deductible. Right, so we have got a 0 here. Then what happens now? What must we do now?
We need to deduct 20,000 from 27,500 for the guitars. Then only 7,500 can be deducted.
I am lost now. How did you get 27,500?
5,500 or for each guitar times 5. Then it gives me 27,500. And then the insurance company paid 20,000. So because of I'm trying to get the deduction. What needs to be deducted?
Why are you deducting? Remind me why you're deducting. I'm not saying you're doing a wrong thing. Why are you deducting?
I'm deducting 20,000 for insurance because of is prohibited to be deducted.
No, I don't follow that.
Mm.
Remember, the only reason why you are doing what you are doing, ne? It's because in brackets here, they say to you, these items were not deducted yet as part of trading stock and production cost. Therefore, it means in any other year, we would have said 27,500 full deduction. This is what we would have said. But because they've already been lost and we have managed to recover a certain portion from the insurer. So this certain portion that has been recovered, which is 20,000, this therefore means we can only deduct what has not been recovered or covered by an insurance payout, which is 7,500. So this therefore means that we only deduct portion not covered by
By the
insurance
insurance.
payout, which is therefore calculated at below, which is 7,500. Any questions? Everyone is clear, ne? Right. So we are done with guitars. Number 11, we already know what number 11 is. We are applying the binding general rule. So it seems we are done with our calculation. We can therefore calculate what we call taxable income.
Sorry, we are forgetting donation.
Yes, remember donations comes after taxable income. So we've got taxable income here, which we must calculate. So we're going to say sum of everything that is above. Let me hope that my positives and negatives are correct. Remember, as a student, if you get this amount wrong because of your calculation, you don't get penalized twice, especially going forward. So you get a mark on how you calculated the tax liability, even if it's different amounts. You won't be penalized because this amount is wrong. So let's apply donations. So donations, there is two important things. It must be to a public benefit organization, and there must be a Section 18A receipt. Does this donation meet the donations requirement?
Yes, it does.
So it does, and the amount is 150. So in terms of the calculation, we say donation is limited to 10% of taxable income, which is now 947,388, or actual amount So if the amount of donation is less than 10%, you deduct the actual donation amount. So we've got 150,000, and here this amount, we can only deduct 10% of this amount, which is 94,739. Can you see that is only limited to this amount? What does this mean? The remainder to be deducted following year of assessment. So this is very important to show that you understand that this is only limited to 94,739, but the remainder can be deducted in the following year of assessment. This therefore says the taxable income will therefore come to an amount of 852,649, which from this amount we can calculate what was required in this question. And what was required in the calculation was a tax liability.
Before you continue, sir, I just want to understand if the company always donates. So if there's always a leftover amount, it will be carrying on in each year of assessment. That's my question.
100%. According to the numbers, you'll keep adding up the numbers. You follow? So in this case, we're going to say 150 minus 94,000, which therefore means an amount that is going to be deducted the following year is 55,261. Should you not have a donation?
Okay, so does this mean that if we had donation that was left from the previous year, we're gonna take that donation and add it to the 150,000?
Yes, if the question led you like that. But remember, you also need all the important things that must be met before you actually put the donation. You need to know if it was to a public benefit organization, and if not, sorry, I'm looking for a SARS website in order to show you that part. Uh, uh, is limited. All right, let's quickly, maybe let's leave this line for now. I will talk about it in the next class. I will just need to quickly check, but the amount is limited to 10%, which is 94,739. The other portion should be deducted in the following year, but I just need to check that. Yeah, I will just check that to be sure. And then we will tackle it in the next classes. But quickly, how much of a tax liability are you getting? Yeah, no, I was correct. Let's not remove it. So I'm just reading something on SARS which says Section 18A rollover provision. Any donation made in excess, let's call it Section 18, fact sheet. There it is. So any donations made in excess of the 10% limit in any year of assessment will be carried forward and deemed a donation in the following year of assessment. So the deemed donation together with other donations actually made in the following year will again be limited to 10% of the donor's taxable income. This process will be repeated until the donation amount has been allowed in full. Do I respond now to that person who asked what happens the following year?
Yes, I now understand clearly.
Lovely. So how much tax liability are we getting?
I'm getting a number which is to a one decimal place, so I don't know if it will be correct. Yes, 238,741,7.
So what is the percentage that you are using?
28%.
Because this is a company, right? So
Yes.
we are saying this is the amount that you are getting. And because the question asked you to round it off, you can say rounded. And then you say the amount is 238,742. So this sometimes is something that you can always use to show the marker that you've got a rounded amount and the amount that you got from your calculator. Any questions with what we have covered today? Whilst questions are coming, I just need to quickly share the feedback form. Whilst entertaining the questions, I need to quickly share the feedback form.
I know this is a question probably asked a million times already, but is there any way that it's easier? Do you have any suggestions on a way that's easier to study all these sections and allowable and not allowable?
The only thing that is important is practice. That's the only thing that is important. That's the only way that you can remember them. That's the only way that you can remember them, Chantel. I know that it seems impossible, but up until you practice, you do a lot of questions. And this year, you are given that provision to have lots of questions. And you can only remember the sections, as I've said, once you practice a lot of questions, because one can be able to see that everything, if you do not understand, it will become an issue. If you do not understand how to apply research and development, if you don't know how to apply bad debts written off, the allowances. So this was not an easy question, but if you understand the principles, the question becomes easy. I've currently unpacked them today. So it's important that you repeat this question one under exam conditions. You learn the principles. So the first time that you attempt a question, try to link a principle to each question so that you don't work with numbers. Text is not numbers, but it is understanding and application.
Sir, the final exam, is it multiple choice or we need to do the calculations like the way we are doing now?
So, the question again?
Is it a multiple choice
Oh,
or?
lovely. I honestly do not know. I do not have an answer for that, Benilda. I saw your question as well. But if you follow my tutorial classes, and the next classes in September, I will bring in the lecturer who is going to give you more or less the format of the exam.
Okay. Thank you so much.
All right.
Hello, sir.
Yes.
I would love to know which sections of the act which sections of the act apply to the small business corporations and which ones do not?
The important thing that you need to know about small business corporation is that from a allowance perspective, you have to apply section 12E, which says when you bring manufacturing asset, you get 100% allowance. Non-manufacturing assets, it's a 50-30-20 over 3 years. Then you also have to know the definition of a small business allowance, corporation, around the gross income limitation and other definition that apply to a small business corporation. It tells you that an entity must be a closed corporation, a cooperative, a private company. Members must be natural persons for the entire year of assessment. Neither of the members must hold any share in the equity of any other company other than people who have been permitted. Investment income and income from personal savings must not make more than 20% of revenue receipts, and accruals plus capital gain. And what I've already said, gross income must not exceed 20 million. So that is the small business corporation requirements. And from a tax perspective, allowances, I've also shared section 12E. Any further questions?
Hello.
Yes.
Can you hear me?
Yes, I can hear you, Mabe.
Why is doubtful debt allowance on 2049 not deductible?
The previous year's doubtful debt gets added back
Oh,
because
okay.
and only the current year becomes a deduction.
Okay.
Yes, it's a principle. But in this question, it's important that you understand that 2049 is previous year and 2050 is the current year.
Okay, sir. Thank you.
Lovely.
And then I want to ask, I want to attend the next class. So I don't
Yes.
know how will I be able to know when it's the next class since well.
Next class is on the 31st of August. Please note, due to due to that you have shared to me that the next the exam date is 1 October 2021. It is not yet confirmed by the lecturers. I had to bring closer all the October dates so that we finish everything in September. So the next class will be 31st August, which is next Tuesday, same time.
Okay, thank you, sir.
Say, I'm not able to see some of the recordings. They are those ones which we did before for the tutorial letters, which are not the revisions. How will I be able to see like this one that we've just done?
It was shared here. If you cannot find it here, I'll be sharing it on the notes which you can have from the Western Cape region notes.
Also, it's under notes.
Yes, it's under note. Every question that I do and the solution, I post them there.
Oh, okay. Thank you.
Yes, I just checked them.
Yes.
I saw the link to download the recorded classes. I just checked now, and the one for last week is not there.
I am going to, as you are speaking right now, I am writing to Brownwen and Richard. Please please confirm when the 17th August 2021 tutorial for TAX 2601 will be posted. That's fine. I've asked. Let's see what's the answer going to be. Ne?
Okay, the last one that I'm seeing is on 20 July, if I'm not mistaken. Yeah, 20 July.
You should have. Yeah, it's the 17th of August that seems to be missing, which is session 10. I'm going to be asking them to put it on.
Okay, thank you, sir.
I say, I'm still on I went on the Western Cape side, but I'm not seeing it because what I'm seeing here, I clicked on the Western Cape region and then it pops up an announcement, tutorial classes, digital learning, writing center. I'm not seeing where it's talking of the north.
All right, let me quickly share my screen.
Okay.
So please check the chat. They've already responded to me. So they will try to put it as a priority. So let's quickly check the Western Cape region. Can you see my screen?
I can see it.
So here is the classes here. So you come here and you will see MS Teams session recordings and resources. And here is text 2601. And you will start seeing all recorded classes from 4 May up until the last class, which you have confirmed 20 July. And if you are looking for notes, it will be here where it says open class notes. You open class notes, and then you will see all the sessions that I've loaded here. Oh, I see. Let me quickly upload. I'll quickly upload now. 17 August, ne? All right, I'll quickly upload 17 August. Please do not forget to fill in the feedback form. 17 August. That must have been an oversight. It's actually loaded on my side at session 10. There it is. There is session 10. The notes that we covered last week, here they are, including the quick activity that we did, and the learning units and the class solutions. So the recording will give you answers per the quick activity and the learning units as well. You will have the solutions and the class solution. I'm just not sure why the session 10 is not showing here as the last one. I don't know. Yeah. Did you get that now?
Yeah, I saw them. Yeah, thank you, sir.
Lovely. Any further questions? Let's quickly speak about TAX601 quickly before we stop. Let me quickly share the rest of the classes for the whole year so that you understand what we must still do and where you are. So this is currently the schedule. I did something now and I don't think I can get that. So let's quickly open it again. So this is the schedule that we had. So we have a class today. One of the things that I can do is to quickly go on downloads. I remember that I opened this yesterday. Right, this is the classes that we have. So what we are saying is we have this session. We have a session 5, which we are going to have here. And session 5, which is just for this year. So we are going to have this class on Tuesday. And then it's going to be on the 31st of August. It's going to be 17 to 17 landscape. I have to delete this class and delete this one. So these are the sessions that we are going to have today. We covered a bit of income and deductions. Next week, we might do the same as well, depending on what you are saying. So this literally means that I have about 5 hours with you, if I'm correct. We might have a session here. We might have it, but this session is not going to be, the session is not going to be full 2 hours. It may be on the 21st of September. This session can even be 30 minutes to 1 hour, just to warn you. It's definitely going to be 1700 to 18. And this will be our last session, which will be covering mostly the exam technique and not necessarily questions, and a few answers back to students. So let us quickly discuss when would you love me to invite a lecturer?
Definitely the next class and the last one.
uh, to please note, the lecturer can only come once. And she will need to come and you will need to prepare questions that are specific for her. Questions may cover syllabus and questions may cover asking anything from an admin perspective, exam related. So I really do not want to bring her on the next class, but I can bring her on any of the 3 classes, which any class can be your choice. So which class will you choose?
7.
I'll
7
nominate the
September.
last one. No, the last class.
7th will be the best one.
Yeah, I'll prefer the last one talking about exam technique.
All right. So we know that we want the lecturer to be with us in September. So I will quickly check her availability. I'll quickly check her availability so that we can be able to discuss between myself and her in terms of her availability when she's available. But let's quickly speak now because this therefore means I have approximately 6 hours that I can share with you in terms of the next classes, which is about 3 sessions. And if you can just indicate to me what are the areas that you might want me to focus on. All right,
For
maybe.
me, sir, the question that we did today, for me, it's a bit challenging. Sometimes I don't know whether it is deductible or not. You know, I'm doing a guesswork in a way.
Oh my word.
Yeah. So yeah, that is a topic that is difficult for me. And provisional text. Yeah.
Provisional text, you have to read a
Yes.
lot of, you have to listen to our recordings. I think I've covered it for more than 8 hours.
Okay.
Please try to pick up recordings, especially from session 3, 4, 9, and 10. I might have covered it a lot on those sessions, but I'm still going to cover it. I'm not saying I'm not going to cover it again. But definitely general deduction formula. I felt everyone was very uncomfortable today. So it's something that we have to cover again. Other people?
Yeah, maybe if we can do this one of apartments. Yeah, because I understand it, but I'm not 100% sure if I understand it very well.
All right. I also encourage everyone who really got lost in today, because this is where the prescribed textbooks becomes handy. But please reread and re-listen to the recording again, and try to unpack the principles as per the recording. You will hear me. It will be exactly what I had explained in class, and you'll also see the application on Excel. So the recording will give you my voice as well as how I applied the information in the scenario and the references that I read on as I Googled them and showed you the application that will be available as well. But the prescribed textbook can also help you in that regard. But the important thing on the apartment is to note that the rental income is separate from purchase price allowance that we calculated, because on the rental income, what we did was to say it's all income that you have earned in a year. So that must reflect. And then the purchase price, we know the allowance of 5%, but what we needed to know was what happens if you acquired the residential unit in the current year of assessment. And that's where the 55% applies. If it is new or unused, or in the case where when we say unused, we mean if it is brought into use in the current year. If it was purchased in the previous year, would have only used 5% in the current year. If it was an improvement, we were going to use 30% if it was an improvement. So it's important that you learn these, because unfortunately, they apply to manufacturing buildings, they apply to urban development zone, they apply to commercial buildings. You need to know the percentage that applies on the year that a building was acquired, improved, or if it was brought on as an unused building. So it's important that you understand those. So I see that everyone was really indicating uncomfortability on deduction, so it's noted. And the calculation of capital allowances, it's noted. So I've noted that we'll have to do a similar question again in the next classes, and I will try to cover that. Anything else?
Sorry, sir. Can I do like provisional tax payment calculations?
Sure, we'll also do that in the next classes. Don't worry. We'll cover that. There was a question that I thought we were going to do today, but nevertheless, we could not do it, but it's fine. We'll do it in the next class. So in the next class, we'll try to cover a bit of what we did today, a bit of capital gains and a bit of provisional tax. We'll see how we can get everything together. Caesar?
Hi, sir. I just want to understand that you are given a sales amount, which is your revenue, that's your income.
Sure.
Then you're given deductions. Like I was looking at mostly the textbook. That's why I'm comparing to what the textbook is saying and what we're learning. But now I just want to understand what will make the lecture or you as a tutor to ask us after the deductions. We must determine whether it's a micro business or while our turnover is a high turnover. Why would you ask us if the business qualifies as a small business corporation? Is it because the income is different, or what would cause that question?
All right. So it's one of the questions that I had hoped that we were going to cover today. But nevertheless, we could not cover. So where you are asked if a company is a small business corporation, a micro business, or a mostly those two would be the questions. They will give you, in case of a micro business, a qualifying turnover. So they will not give you a qualifying turnover, sorry. They will give you sales, they will give you what is made, how is sales made up of? Is it receipts, cash receipts? Is it a debt which has not been paid, an amount that has not yet been paid in a year of assessment? And what is important is you need to understand how to calculate a qualifying turnover. And then from calculating a qualifying turnover, you need to also to know how do you calculate a qualifying turnover limit. Because remember, a qualifying turnover limit is 1 million, which is used to see if a taxpayer is a micro business. So a qualifying turnover limit is calculated in a year of assessment. So you need to know how long has the company carried on trade in the year of assessment that you want to calculate the limit. It may be months. So if it is months, you need to convert your sale amount into months. Sorry, you need to convert your turnover limit into the months that the business was carrying on a trade. So for example, let's do this example quickly. If you had a trade for 9 months of 12 months in a year of assessment, this means that your turnover limit will be 1 million. And this 1 million, remember, it's applicable in a full year of assessment. What's happening now there? Okay, it's because of this R. 1 million would be applicable in a full year of assessment. Now, to calculate a turnover limit, would have to say 1 million times 9 divided by 12, and then your turnover limit that you are going to apply in a scenario becomes 750,000. And then you check against the qualifying turnover of the particular company, whether it is less or more than 750. If it is less, it qualifies as a micro business. If it is more, it does not qualify. So these are the things that you need to know. And in terms of a small business corporation, I've already given you the 5 important things about a micro business. The entity must be a closed corporation or a private company. Shareholders must be natural persons. They must not have any other shareholding or interest in any other company unless they've been permitted to do so. Investment income and income from personal service must not make up 20% of revenue receipts. And accruals. Accruals means even if we have not received it, but we owe it, it was incurred in the current year in terms of the accrual principle, plus capital gains, and gross income does not exceed 20 million in a year of assessment. So all those things you need to know. You can reflect on on learning unit 3, where I covered this. Possibly in session 2 or session 3 of the recordings, I would have covered that part. Any
Thank
further
you.
questions? Lovely. Thank you very much for today. If there's no further questions, then let's quickly adjourn for today. Let me wish you the rest of the evening and good health going forward and in preparation for your exams. Thank you very much for tonight.